It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump weighs Iran's proposal to end the war. His remarks said to be coming very soon. Brent climbs back above $110 a barrel. Futures lower after stocks hit fresh records yesterday. And earnings continue to roll in with GM, Coca-Cola and Starbucks all on deck. So let's get a check on markets around the world now. Winnie Su is in Hong Kong for the latest from Asia. Winnie.
Good morning, Bonnie. We're seeing Asian stocks under a bit of pressure today with the higher oil prices and also technology shares losing a bit of steam. Now, bucking the trend, you can see that the South Korea Kospi index actually closed in the green, and its market cap, in fact, surpassed that of the UK, making it the world's 8th biggest stock market, thanks to the boom in AI. Now you flip the board and take a quick look at the Japanese yen, because today we had the Bank of Japan delivering a hold as expected. The yen initially strengthened on how there were 3 descendants who voted for a hike. However, those gains quickly reversed during the presser, where we heard Governor Ueda sounding less hawkish than expected, as he signaled very little clarity in terms of where the rate path will go going forward. And for now, we are expecting 66% of chances of a June hike versus 75% earlier.
All right, so those chances lower. Winnie, thank you so much. We are 2 hours into the European Open. Here's Justina Lee in London. Justina.
Good morning, Vani. Here we're seeing European stocks swinging between gains and losses this morning. But when it comes to Swiss stocks, it's definitely in the red here after that Novartis earnings report. And in terms of bonds, generally yields are up today after the European Central Bank said that inflation expectations jumped in March. Now, if we kind of look at UK long and gilt yields in particular, those have been up pretty kind of drastically all year. Of course, part of that is oil. But could it also be a political risk premium, with UK Prime Minister Keir Starmer facing a vote on a potential investigation today, Bonnie?
All right, Justina, thank you so much. Justina Lee there in London. Let's take a look at this oil market, because we topped $112 a barrel on Brent just a little while ago. We're back below that now, but still up almost 3%. And if you look at WTI, we are just fractionally off $100 a barrel once again. If you remember, at the peak, we saw Brent at 120, so we're really not far off the peak that we've seen Brent at during this war. Pump prices also at 411, almost at the peak for this war season. We are 2 months in, of course, and there doesn't seem to be any improvement. Floating storage is at a record now, like an all-time record. We're seeing yields creep higher. The 30-year yield also close to its high of the year. And if we look at stocks and equity index futures, as you might imagine, they are pointed lower today. Though this market does seem to be throwing off the oil risk just a little bit. We have NASDAQ 100 futures much lower than S&P 500 futures on the AI story. Gold perhaps showing it just a little bit more. Gold at just over $4,600 now, down 1.2% today. And daily average volume has been lower this month than any month this year. So perhaps investors are just taking a step back to wait for some other development. Let's get to some individual movers now. And for that, we'll go back over to London and Charlie Wells. Charlie.
Good morning, Vonnie. So really, pre-market U.S. seems to be digesting a lot of earnings news that we've been getting. So Bed Bath & Beyond, they had a really strong revenue beat here. We're seeing pre-market up over 22% here, almost 23%. Let's flip and take a look at Joby. This is the air transportation company. Yesterday, they had some test flights for basically their, kind of vertical flights from JFK to Manhattan, up almost 3% here. And finally, let's end on Rambus. That is a semiconductor technology company. They had a miss on earnings per share, and the pre-market not liking what it's seeing here. High bar in this semi space. This stock had a great 2025, but again, market not liking that miss on earnings per share for Rambus.
No, a nasty drop there, 15%. Charlie, thank you so much. We'll be seeing Charlie again a little later. Great lineup for you all together this morning. Mark Haefele of UBS joins us on his outlook for growth and inflation. Also this hour, Cayla Seder of State Street as we push ahead to the Fed decision. But first, President Trump prepares to address Iran's proposal.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear, not just to the American public, but also to them as well.
Joining us now from Dubai is Jumana Bersetchi. Jumana, what's the hold-up, and is there some kind of a concern over who might have submitted this proposal from Iran?
Yeah, well, what we understand is the proposal came through from the Iranian side after the Iranian foreign minister's whirlwind trip through the region over the course of the weekend. Several trips to Islamabad, then to Oman and to Russia yesterday, after which Pakistani mediators presented their version of what they would like to see in order to end the war to the U.S. Now, we haven't got an official response yet out of the White House. Karoline Leavitt there saying that the response will come soon. But what we do know about the proposal and what was being reported by Iranian state media over the weekend is that they are presenting almost two phases to the conditions that they think are necessary to proceed with discussions. Number one is a mutual lifting of the blockade around the Strait of Hormuz, and only after which a deferral of sorts around the negotiations of the nuclear files. So segregating the two issues. Now, this morning we've heard from reports on other media, New York Times, Wall Street Journal, suggesting that some of the conditions that Iran have put forward would be unacceptable to the U.S., namely because they are also asking for guarantees that the war won't be restarted again, war reparations, and of course, President Trump has reiterated time and time again that you can't separate the nuclear file with Iran from everything else and with the lifting of the blockade around the Strait of Hormuz. So as we await the formal U.S. response, one other element to consider as well, Vonnie, is that in President Trump's eyes, and this is also comments that were echoed by Marco Rubio, the Secretary of State yesterday, the U.S. naval blockade is actually being successful. And so the question here is, why would they lift it if they deem that over the next 10 to 15 to 20 days, the Iranian economy will start hurting more and more because of the curtailing of oil shipments? Why would they give up that leverage now? And so this is a question that I think we need to get an answer to in the coming days to determine whether this blockade will be lifted or indeed we can proceed to the second round of negotiations.
Jumana, tell us what the Strait of Hormuz looks like right now. At one point, we actually had been seeing tankers get through. That's completely stopped now, right?
Yeah, essentially, it's been very, very quiet over the last couple of days. Very few vessels getting through. But one of note, though, overnight, it seems as though the first carrier carrying or first vessel carrying LNG actually was successfully made it through the Strait of Hormuz. This is the first LNG shipment that has occurred since the beginning of the Iran war. So it's been 2 months since an LNG ship actually made it through. That seems to have gone through, and it was carrying gas that was loaded from a UAE facility. And then also in the last couple of hours, we've been monitoring the movements, again, of another tanker that appears to be carrying oil from Saudi Arabia as well. So maybe some of the lines are beginning to, or some of the hurdles are beginning to be softened. But I will say as well that there's lots of evidence to suggest the buildup of those Iranian tankers and that they have been unable to get into the U.S. blockade zone, which is exactly what the U.S. CENTCOM and what the U.S. presidents would like to see.
Yeah, absolutely. Jumana, thank you so much. That is Jumana Bersetchi. So as we've been saying, Brent crude rising above $110 a barrel as traders await a response from the U.S. to Iran's proposal. Joining us now is Bloomberg's Will Kennedy. Will, what are traders pricing in now? I mean, we saw 120 at the peak fear, right? But prompt month at 112. What is that suggesting to us?
We have seen prices ratchet steadily higher over the last couple of weeks since the US imposed that blockade on Iranian exports. And I think that's the big change in the market that Jumana was describing. Previously, the Hormuz was closed to most ships, but Iran was able to get its oil out of it, a really important source of supply for China in particular, perhaps 2 million barrels a day or so. And clearly we can see that's been severely curtailed. We can see that because of the tankers loaded but not crossing the Straits of Hormuz that we described a moment ago. So that's been a big change in how traders assess the balance of supply and demand over the last couple of weeks. And as talks between the US and Iran appear stalled with a no breakthrough in sight, that means we're seeing prices steadily ratchet higher because there isn't the oil available that traders were expecting a few weeks ago.
Yeah, and floating storage or crude stuck in the Middle East is now at a record. So what happens next? I mean, Do oil fields have to start getting shut in again at some point?
That's a question. I mean, obviously, some oil fields remain shut in countries like Kuwait and Iraq because they haven't been able to export their oil for many weeks now. The US bet here is the blockade will force Iran to shut in oil fields, and that will be very painful for the Iranian regime, both because it will deprive it of oil revenue and it will cause lasting damage to its oil industry. It's a really important question how that comes out in the future days and weeks ahead. Iran, it's worth saying, has confronted challenges to its ability to produce and export oil before. In the previous Trump regime, where there was this policy of maximum pressure, exports plummeted, but the regime survived and the oil industry survived. So then how this plays out and how the pressure on the oil industry feeds through into negotiations will be all important to how the market develops in the coming days and weeks, Bonnie.
Speaking about energy, the companies are starting to report, obviously, and BP profit just blew everything out of the water, right? So it's been a boon, obviously, for some energy companies, but there must be some concerns in the background as well for energy companies in terms of supply lines. Also, demand destruction must be coming down the pike at some point.
There are two things to say about BP. One, it has a big trading business, and that trading business performed exceptionally well in the early weeks of the war. It allowed traders to really make money as they readjusted and helped the global picture adjust to the facts of the closure of the Straits of Hormuz. And the second thing is that uniquely among some of the biggest oil companies, BP does not have big operations inside the Strait of Hormuz, so its production, in contrast to rivals like Exxon and Shell, has not been adversely impacted by the closure of the Strait of Hormuz, and it's able to take advantage of these high prices while maintaining its production at pre-war level. So that's why BP has done well. Longer term, yes, clearly this is a problem for the oil industry, especially those companies that do have production inside the Persian Gulf. But there are opportunities there as well, principally in the form of higher oil prices for the rest of their portfolio.
Will, fantastic context as always. Thank you so much for joining. That is Bloomberg's Will Kennedy. Now to other top stories trending on the terminal this morning. The Bank of Japan held steady, leaving interest rates at 75 basis points. The vote was split, though, 6-3, boosting the odds of a rate hike in June. BOJ Governor Kazuo Ueda said the outlook is now less likely as the war in the Middle East clouds growth prospects. Barclays traders struggle to capitalize on a volatile trading quarter. First quarter results beat expectations but lagged much of its Wall Street rivals. Fixed income traders brought in about $2.3 billion, broadly flat year on year. Barclays is the first major UK bank to report first quarter results. And late-night host Jimmy Kimmel came to his own defense after backlash over a joke he told last week, saying First Lady Melania Trump, quote, "You have a glow like an expectant widow." Kimmel responded to the First Lady, calling the comments, quote, "hateful and violent."
I agree that hateful and violent rhetoric is something we should reject. I do, and I think a great place to start to dial that back would be to have a conversation with your husband about it, because should point out, Donald Trump is allowed to say whatever he wants to say, as are you, and as am I, as are all of us, because under the First Amendment, we have, as Americans, a right to free speech.
Coming up, Mark Haefele of UBS joins next on his Global Growth Outlook. This is Bloomberg.
Our research has revised down our growth estimates in the US and around the world slightly, maybe slightly less in China. And we've revised up inflation more than 140 basis points in Europe, for example. So we really see an inflation shock coming through to some extent, and we see growth mitigated.
Mark Haefele of UBS also weighing in on growth, writing, quote, "We think growth should stay resilient. Inflation is likely to undershoot market expectations, and there is adequate demand to meet higher supply of debt. Our base case is that the growth drag from higher oil prices is manageable." Mark joins us now. So Mark, why so sanguine? Why do you think growth will hold up and inflation might perhaps not meet what the market is anticipating?
Well, I think the clip you just played, which we didn't pre-schedule that, but that just set it up perfectly, right? Which is that you're talking about perception in the markets of inflation shock. So I guess what we're saying is that growth, yes, our growth expectations have come down some, but we still see positive growth. You know, the U.S. growth slightly higher this year than last year, on the back of continued CapEx spending, on the back of government expenditures. And on the inflation side, yes, headline inflation will pick up. It could have a four handle on it. But what we're saying is that the central banks are not as likely to start hiking rates as the market seems to anticipate. So higher growth, higher growth, lower than it was originally expected, higher inflation, but yet central banks probably not as willing to hike as some in the market think.
In fact, you think the Fed will still cut this year by 50 basis points between now and year end. Explain why 50 basis points will be necessary.
Well, I think that there's a couple of things. First is and I'm sure you have heard Kevin Warsh's testimony, there is an inclination to take on board some of these effects from AI and other things that point in a dovish direction. Secondly, there's the risk case where, in fact, the economy does start to feel the effects of a prolonged war. And, in that case, growth starts to be questioned, and that's probably also not a place where the Fed wants to just leave rates alone. We came into this year thinking that they would cut rates. That's been slowed considerably. We don't think they're going to cut right away, but that if the war ends or if the war continues, both of those scenarios could actually lead to rate cuts.
You say that investors should definitely diversify their exposure beyond mega tech companies at this point, but at the same time you also like China AI. Can you explain where investors should diversify to? And then we'll get to the China bit in a moment.
Well, I think that the messaging there, there's a couple levels. First, while our base case is that the growth continues and that earnings growth is going to continue, the longer we go with this high in oil prices and the longer that a lot of the feedstocks and other things can't get out of the Strait of Hormuz, there are some things that are going to start to break in the supply chains. Maybe somebody was saying to me, well, if you can't get the components out to make the plastics, somebody's going to have an assembly line somewhere where they can't get an air hose or something like that. And so those things are going to start to happen soon, and those are kind of individual cases. But when you take a step back from that, it's the quality companies that have the margin power that are probably going to continue to be able to get whatever they need. So that's one level of where you should be looking through this. And then a second is we've had these big themes of AI, power and resources, and healthcare, and those have held up remarkably well. In fact, coming back to your point, with AI, it's just done so well that we have many clients who really now have outsized bets on some of the mega cap tech companies. And we're saying, look, in this base case, we expect this rally to broaden out. And given the uncertainty as well, maybe there is some room for diversification in portfolios.
So I'm curious about the China part, though, because the latest DeepSeek model didn't seem to impress that much at all. And apparently China is still 6 to 12 months behind the US when it comes to agentic AI and so on. Why are you recommending that perhaps customers get exposure to China?
Well, the China tech stack is separate from a lot of these other bets. So one, it is a diversification bet. Two, DeepSeek may not be the best frontier model out there, but it is also significantly cheaper than some of the best models. And so, there's the flip side risk, which is actually that Western companies start using it because it gets the job done, and it does it at a cheaper cost as well. So there's two sides to this. As part of the diversification, playing both of those elements makes some sense.
Mark, we have to leave it there. Thank you so much, Mark Haefele of UBS Global Wealth Management. This is Bloomberg. Time now for your front page news. First up, the Wall Street Journal reporting OpenAI recently missed its own targets for new users and revenue. The Journal says it's raising concern about how it's going to support its spending on data centers. Next up, the Financial Times reporting Wall Street dealers' treasury holdings have jumped to the highest since the global financial crisis. They now represent about 2% of the total. And finally, coming up on the Washington Post, we have the Washington Post reporting the Supreme Court is considering blocking lawsuits alleging Monsanto's Roundup weed killer causes cancer. It would be the largest wave of product liability litigation in the nation's history. This is Bloomberg. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump weighs Iran's proposal to end the war. His remarks said to be coming very soon. Brent crude climbs back above $110 a barrel. Equity index futures lower after stocks hit fresh records. And earnings continue to roll in with GM, Coca-Cola and Starbucks all on deck. Let's take a look at those markets then, because Brent crude is now above $111 a barrel and WTI is so close to $100 a barrel. No surprise that pump prices are close to their highs of the year at $4.11. The war peak for a barrel of Brent, by the way, was just $120, so we're really not far off that peak. Obviously, that's impacting everything else, but also you had semiconductor stocks breaking their 18-day winning streak yesterday. You can see S&P futures are lower. NASDAQ 100 futures in particular much lower, partially on that AI story, the OpenAI story, and gold down 1.4%. We have the VIX a little bit elevated, but it is lower than this time yesterday, and yields close to their highs of the year. The 30-year is very, very close to its high of the year. Let's get to some individual movers now, though. Here's Charlie Wells. Charlie.
Good morning, Vonnie. Well, the market seems to be reacting to that report about OpenAI missing sales targets and user targets. If you take a look at these companies that serve as something of a proxy for OpenAI, you can see a lot of red behind me. So negativity in the market on that report about those missed targets. Different story when you look at Bed Bath & Beyond. They had a really positive earnings report yesterday, beating revenue expectations, up over 26% this morning as they try to expand into different parts of the consumer experience, saying they had a lot of engagement from consumers. Different type of consumer engagement if you think about Joby. That is the aviation company. They this week have been flying test flights of electric taxis from JFK to Manhattan. You can see up over 1% here. Excitement about that as the U.S. pushes more into this space.
Yeah, they are looking for regulatory approval. Apparently no passengers yet, Charlie, but they will have them potentially later this year. It's exciting. That is Charlie Wells in London. Cayla Seder of State Street looking ahead to the Fed decision tomorrow, writing, quote, "The conflict with Iran has not materially changed near-term rate expectations. Instead, the most notable impact has been to forecast 6 months and beyond." I'm pleased to say Cayla joins us now. She's macro multi-asset strategist at State Street. So we just had Mark Haefele from UBS Global Wealth Management basically saying growth is going to hold up, and we expect 2 cuts later this year. Is that pretty much where you're at as well?
I don't think we need quite 2 cuts. But I definitely agree that the economy is holding up okay. We had strong retail sales. We've had a still robust labor market, even if we are kind of at that equilibrium level. And I think what that means is that it opens up the Fed to focus more on inflation. So that's why I would push back on the 2. However, I think the market is really hesitant to move away from a prospect of the next move is going to be a cut. And so I think that's why 1 cut is not out of the question this year.
How do you weigh up all the dynamics? Because we know there may be a bias towards cutting if Kevin Warsh gets confirmed, and assuming that he takes over from Powell immediately after Powell's next press conference, right? So there is a bias towards easing potentially, but then you also have those inflation dynamics and, you know, no one's quite sure how that's going to ripple through into the economy, right? It's not supposed to. They're energy prices, but we know that in this case they will.
Yeah, I think, you know, watching does headline feed into core is going to be extremely important. So I would keep an eye on that. So far, what we see in our daily measures of inflation is that it's not feeding into core yet. So that gives the Fed some time to stay on pause if they need to. The other thing I would look at are inflation expectations, because if we see long-term inflation expectations rise, it's going to be challenging for the Fed to ignore that, especially because the Fed has been out of mandate for so many years in terms of getting inflation back to 2%. And so when we look at long-run inflation expectations, I think there's two ways to look at it. One is looking at the consumer, the second is looking at the market.
So what happens if we do get a cut later this year, right? I mean, growth is supposed to hold up. We get a cut and suddenly, what, we get a booming economy once again and the stock market continues to just blow past everybody's expectations?
I think the stock market could continue to blow past expectations. But in terms of will one cut really cause that, I don't think it would. You know, right now we're already in this neutral territory, and that band of neutrality could be somewhat wide. And so I think just getting one more cut is not going to make a huge difference in terms of stimulating the economy. I think it's much more about what are expectations for the path forward from there. If the market gets very excited that there's going to be tons and tons of cuts, I think that could propel sentiment. But in reality, the data are just too strong right now to expect many cuts.
Let me read something that BlackRock has been writing and it pertains to yields being higher, right? Because we're very close to our highs of the year and there's no saying where they'll go. But BlackRock writing this, we think higher yields are here to stay and that long-term government bonds are no longer effective diversifiers against equity declines. Now, you're not really expecting equity declines, but if you want some kind of a hedge in there, where would you go now, Cayla?
I think it matters within the equity space. So you can diversify within, the asset class. One thing that we've seen is we have started to see a bit more demand for energy. One thing that's interesting, though, when we think about concentration risk and where do you want to be if the Fed is going to cut, but maybe not by that much. I still think tech looks good in that environment because we still see high measures of quality, so high ROE, and less leverage risk relative to a lot of other parts of the market. And the reason why that matters is that even if the Fed cuts, there's limited room to continue to cut by a large magnitude. And so sticking with higher quality parts of the market, I think, makes sense here, especially because the future outlook is just so uncertain.
Do you have to be more discerning when it comes to tech now, though? Bloomberg Intelligence put out earnings estimate expectations, and ex-tech, we're only looking for earnings, or at least net income growth of 4.1% this quarter. But if you include AI themes, you're talking about 28.2%. I mean, is it still AI and only AI?
Not all parts of tech are created equally. So, thinking of it as large cap versus small cap, definitely still preferring that large cap area. And then also keeping an eye on industry group performance as well, because software hasn't been as attractive in terms of what we see in our real money data as tech hardware and semis. Tech hardware and semis have attracted continual demand over the last year, whereas software has wavered a little bit. Now, the flip side of that is that now software positioning is much lower relative to tech hardware and semis. And so theoretically, there is more room for upside, which is challenging to find given we've been in this tech run for so long. Where else is there room to add?
What about the gold trade, Cayla? Is it over? Is it done?
I think what we've seen with gold is that it hasn't proven to be this hedge that everyone thought it was going to be. And so I think what that means is you have to really struggle to find what is the safe haven. So one thing that has changed in terms of safe haven demand that we saw about a month ago is we are definitely starting to see more demand for the dollar. Now that has actually started to reverse, and we're not seeing demand for the dollar quite so much. In fact, we're seeing really strong selling out of the dollar. And so I think taking a step back, a lot of the questions have been, what is the safe haven right now? Is it the dollar? Is it gold? Is it tech? Is it certain parts of treasuries? And I think really what we've seen investors remain comfortable with over this entire conflict is still this tech space.
All right, Cayla, we have to leave it there, but thank you so much. Pleasure to have you in studio. Cayla Seder of State Street. Now to other top stories trending on the terminal this morning. The Bank of Japan holding steady, leaving interest rates at 75 basis points. The yen strengthened soon after the decision, but paired gains after BOJ Governor Kazuo Ueda cast doubt on the economy's outlook during his news conference. Barclays traders struggling to capitalise on a volatile trading quarter. First quarter results beat expectations but lagged much of Wall Street. Fixed income traders brought in about $2.3 billion. That was broadly flat on the year. Barclays is the first major UK bank to report Q1 results. And late-night host Jimmy Kimmel came to his own defence after backlash over a joke he told last week, saying First Lady Melania Trump, "You have a glow like an expectant widow." Kimmel responded to the First Lady, who called Kimmel's comments hateful and violent.
I agree that hateful and violent rhetoric is something we should reject. I do, and I think a great place to start to dial that back would be to have a conversation with your husband about it, because, by the way, I also should point out, Donald Trump is allowed to say whatever he wants to say, as are you, and as am I, as are all of us, because under the First Amendment, we have, as Americans, a right to free speech.
Coming up, Brent crude marching higher, above $111 a barrel, as the world awaits Washington's response to Iran's proposal. More next. This is Bloomberg.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear, not just to the American public, but also to them as well.
President Trump weighing Iran's proposal with his aides as the war now enters its third month. Mika Solner of Bloomberg Government joins us live from Washington. When should we expect a response from the president, Mika?
Yeah, negotiations are very tense right now. There's no concrete timeline as to when we may see an update on this. And the main issue that could potentially lead on this issue is obviously opening the Strait of Hormuz. And that would be in exchange for the U.S. Temporarily ending its blockade, which has been a tension point. There's still broader negotiations to be made as well related to Iran's potential nuclear ambitions, which they have denied. But that's Trump's main issue here. But we should see more news maybe this week, next week. The president's schedule is very full this week, but there should be an update very soon, as we just heard Karoline say.
What about the King Charles visit? Did it improve relations at all with the United Kingdom?
Yeah, the visit comes at a really fragile time right now. Of course, the president has not been shy to criticize UK Prime Minister Keir Starmer for not supporting essentially the US's military intervention in Iran. So there's a lot of tension there. Overall, things have been really calm. But of course, the royals' visits also come during a time of heightened security concerns in Washington after Saturday's incident at the Correspondents' Dinner. So it's very fraught. We're going to see more activity today between the royal family and the White House. So we'll stay tuned there as well.
And what update do we have about the suspect in that potentially assassination attempt?
Yeah, we saw that the suspect yesterday was charged with trying to assassinate the president, as well as bringing weapons, firearms across state lines. And this is a very fragile and sensitive situation to everyone involved in Washington beyond the White House. There are many of us who attended the dinner, including myself, who will be watching this closely and also really aware of some of the rise in political violence. So we heard from the White House that it's potentially open to changing some of the protocols there, but we're going to see what happens when it comes to security around the president.
Okay, Mika, thank you so much. Bloomberg Government's Mika Solner. Oil continues to march higher. Brent crude staying above $110 a barrel, bringing the gain just this week to almost 6%. And it's only Tuesday. Joining us now is Bloomberg's Anthony DePaola. Anthony, we're just a few dollars off the war high. What is this market saying?
Good morning, Bonnie. Yeah, oil had cooled off when there was discussion around talks towards a deal, potential movements towards opening the strait. But because those talks fell through last weekend, we didn't have any advancement. Oil's come back, added some of that risk. We've seen some of the risk still around shipping there because even though we do have a ceasefire in place, so we haven't had active attacks going on across the Gulf, we have still had that Iranian effective closure of Hormuz going on. And then just beyond that, the U.S. blockade. So the U.S. is stopping any Iranian vessels from leaving the Persian Gulf or any vessels that are heading towards Iranian ports. So remember that even during the conflict, Iran had continued to export some of its oil. So that was one of the few producers that was able to ship oil through the Strait of Hormuz. And that has been halted now by the U.S. blockade. And the U.S. has even interdicted a couple vessels and stopped them from traveling on to their locations. So really the key factor that we're watching there is Hormuz, is the free flow of oil. And without that, we're really not going to get prices that are going to be sustainably lower. So they're still really being elevated by the blockage of that shipping there, Bonnie.
Yeah, Anthony, I mean, can we, tell how much each marginal day adds to a barrel of prompt futures or even further out futures?
Yeah, well, we're still at this risk premium kind of area. We are saying, as you say, we're off of that high, but that was a high, remember, when we saw when there was actual conflict going on. So we are still pricing in the risk of some of that conflict coming back. Some capacity has been taken off, but really people are pricing what's happening now because it's difficult to look at what's going to be going on with the future because a lot of those benchmarks that are coming out of the Gulf, Dubai crude, for example, is not coming out, so it's difficult to price those crudes. So really, people are pricing higher what's now coming out based on the current risks, and that's a real question mark as to whether even next month we'll have new barrels coming on the market, and then what happens to the market then. Clearly, there's going to be continued demand in the market, but we have seen some demand destruction. We have even seen some margins for refiners that are hurt. So it's going to take time to get that oil back to the market, and that's going to impact, how quickly that can come back, how quickly buyers can take it, and that demand destruction is also going to hit that uptake as well too, Vani.
It's been good news, at least for the likes of BP. This quarter, we saw net income more than double because of a surge in profits from trading and refining in particular. But will it always be a boon to energy companies in general, Anthony, or is there a certain point at which it starts to become a problem for them too?
Yeah, the general accepted figure is somewhere north of 120 for crude that we start to get that demand destruction, and so that's a bad picture. It's positive if you're going to sell your main product at a higher price, but if it gets too high in the case of oil, people start using less. If we look particularly at this region, of course, we've got Saudi Aramco will be coming out with its earnings in 2 weeks' time, and they have probably gained some money from the higher barrel price. Of course, they've been able to sell fewer barrels during the month of March, the main month that the war was taking place here, but they got a higher price for that. But of course, that's got to be weighed against the damage to the broader economy. There have been attacks on facilities, so that's going to cost money to repair, to the reputation of the Gulf as a destination for capital and for people to come and invest and even live. So weighing that against the broader economy, of course, it looks like a loss. Plus, yes, even with companies like BP, like Exxon, you've got to look at the fact that they've also lost production because they are big producers here in the region as well, too. So it's really weighing those different factors. But, when you're talking about interregional war like this, the net effect is going to be a loss. Yeah, for sure. Anthony, thank you so much. Bloomberg's Anthony DePaola. Turning to earnings now, with GM set to report before the bell. Let's get a preview from Stefan Nicola. So, Stefan, what should we expect given that it's a tough comp year over year?
Yeah, exactly. It's a very tough comp. Last year, the same time, buyers rushed to car showrooms to lock in prices before President Trump's tariffs hit. So the expectation is for a slight decline in sales and profit for GM. But the bigger question will be, how is demand looking? What's happening right now? What are the expectations for demand going forward, especially with all these geopolitical crises going on right now?
What about gas prices and how that's going to be impacting sales going forward? Are there particular models of GM that, might even get discontinued, or, that production will at least move a lot lower?
Yeah, I mean, I don't think we're at the point of discontinuing models yet. But of course, the big question is, how will demand for GM's big SUVs develop, right? The Cadillac Escalade, the Chevy Suburban. These are very profitable models. And, customers may opt to go for more efficient, smaller cars, maybe even EVs. So, yeah, that's the big question for GM, but also for the U.S. auto industry as a whole. Will these fuel prices dent demand for cars in the long run? One thing's clear, if the war continues for much longer, then the risks will elevate for GM, but also for the U.S. auto industry as a whole.
All right, Stefan, thank you so much. Stefan, Nicola will be looking out for those earnings before the opening bell. And don't miss our interview with GM CFO Paul Jacobson. That's at 7:30 a.m. Eastern. Coming up, earnings from consumer-based companies as well. We'll get you set up for your trading day. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Earnings galore, of course. We're going to hear from General Motors and then Coca-Cola, Starbucks and many other consumer companies as well. Data-wise, we get ADP employment change. That data out at 8:15 a.m. Eastern. And the U.S. Treasury is auctioning off $44 billion of 7-year notes. That's at 1 p.m. Eastern. Plus, keep an eye out for Bill Ackman's Pershing Square IPO pricing today. Some movers before the open. Oracle and other OpenAI-linked stocks are lower now, including AMD, also CoreWeave, all down in pre-market trading, following the Wall Street Journal report that OpenAI recently failed to meet its targets for sales and new users, which is causing some concern, I would say, in this market. Bed Bath & Beyond, though, is ripping, up almost 27% and extending post-earnings gains after first quarter revenue beat estimates. And Joby Aviation, well, we all know what the story there is. Flying taxis in New York City. It started testing them yesterday. No passengers yet, of course, but looking for regulatory approval. This is your macro picture as we head into just the Tuesday session. It feels like a week already, but S&P futures pointed lower after hitting that record yesterday. The dollar index up. And look at Brent. We are just $9 off the war peak. That is it for Bloomberg Brief. Surveillance is next. This is Bloomberg.